Should you stop buying SCHD? It's a question that more and more dividend investors have been asking lately. SCHD has become one of the most popular dividend ETFs in the world. Millions of dollars continue flowing into the fund every month. And for years, it's built a reputation as one of the best dividend ETFs available. But recently, some investors have started questioning whether SCHD has lost its edge. Maybe you've heard comments like, "Dividend investing is dead. SCHD is underperforming. There are better ETFs now." Or maybe you've looked at your own portfolio and wondered, should I keep buying SCHD, or is it time to move on? Well, the answer isn't simply yes, and it isn't simply no. Because whether you should continue buying SCHD depends on one very important question. Why did you buy SCHD in the first place? Today, we're going to break it all down. We'll discuss why some investors are losing confidence, whether those concerns are actually justified, and the one mistake that causes many investors to give up on SCHD too early. Let's get into it. First, what exactly is SCHD? Before deciding whether you should stop buying SCHD, let's remind ourselves what it was actually built to do. SCHD stands for the Schwab U.S. Dividend Equity ETF. Its goal isn't to find the fastest-growing companies. It isn't trying to beat technology stocks every single year, and it certainly isn't designed to produce the highest dividend yield on the market. Instead, SCHD focuses on high-quality U.S. companies with a history of paying consistent dividends. But here's what many people overlook. SCHD doesn't simply buy every company that pays a dividend. It uses a screening process. It looks at factors like profitability, cash flow, dividend sustainability, and overall financial strength. In other words, SCHD is designed to own companies that have the ability to continue paying and growing their dividends over time. That's a very different objective than simply chasing the highest yield. So, why are some investors selling? Now here's where things get interesting. Every time the market changes, investor opinions change. When technology stocks are soaring, people suddenly forget about dividend investing. When high-growth companies are outperforming, many investors begin asking, why am I holding SCHD when I could be making more money somewhere else? And honestly, it's a fair question. If another ETF is outperforming SCHD over the past year, it's natural to wonder if you've chosen the wrong investment. But here's something every long-term investor should remember. Not every investment is supposed to win every single year. Different investments perform better during different market environments. Growth stocks have their seasons. Dividend stocks have theirs. Small-cap companies have periods where they outperform. Large-cap companies have periods where they dominate. That's simply how markets work. The mistake happens when investors expect every investment to outperform all the time. No ETF can realistically do that. The biggest mistake SCHD investors make, in my opinion, the biggest mistake isn't buying SCHD, it's buying SCHD with unrealistic expectations. Some investors buy SCHD hoping it'll perform like a technology ETF. Others expect it to produce extremely high monthly income. Neither of those is what SCHD was designed to do. SCHD is built around dividend growth. That means owning companies that not only pay dividends today, but have the financial strength to increase those dividends over many years. That's a completely different investment philosophy. Imagine buying a pickup truck, then complaining because it doesn't drive like a sports car. The truck isn't the problem. It's simply being judged against the wrong expectation. SCHD is very similar. If you're expecting explosive growth every year, you'll probably be disappointed. But if your goal is building reliable income over decades, SCHD begins making much more sense. Let's talk about dividend growth. One reason many investors continue buying SCHD isn't today's dividend, it's tomorrow's, and next year's, and the year after that. Dividend growth is incredibly powerful because it creates increasing income without requiring you to purchase additional shares. Imagine two different investments. The first pays a higher dividend today, but never increases it. The second starts with a slightly lower dividend, but consistently raises its payout over time, years later. The second investment could actually be paying you significantly more income. That's one of the reasons experienced dividend investors often focus on dividend growth rather than simply chasing the highest current yield. Growing income can become far more valuable over long periods than temporarily high income. But what about total return? Now let's address another criticism. Some investors argue that total return matters more than dividends, and there's definitely truth to that. At the end of the day, your portfolio value matters, not just the income it produces. That's why comparing investments requires looking at both dividend income and long-term growth. A high dividend doesn't automatically make an investment better. Likewise, a rapidly growing stock isn't automatically the better choice either. The best investment depends on your personal goals. If you're decades away from retirement, you may prioritize growth. If you're approaching retirement, reliable and growing dividend income may become increasingly important. There's no universal answer, only the answer that's right for your financial plan. Who should probably keep buying SCHD? Let's make this practical. SCHD may continue making sense if you're building a long-term dividend portfolio, you value quality companies, you appreciate growing dividend income, you prefer lower portfolio turnover, and you want an investment you can comfortably hold through multiple market cycles. Those characteristics haven't suddenly disappeared. SCHD is still pursuing the same objective it's always had. The market environment may change, but the strategy remains consistent. Who might consider something different? On the other hand, SCHD may not be the best fit for everyone. If your primary objective is maximum growth, you may naturally prefer growth-focused ETFs. If you're looking for exceptionally high current income, other income-focused strategies may align more closely with your goals. And if you're constantly switching investments based on whichever ETF performed best over the last few months, you may want to step back and ask yourself whether you're investing based on a long-term plan or simply reacting to recent performance. Sometimes the biggest improvement isn't changing your ETF, it's changing your expectations. So, should you stop buying SCHD? For many investors, probably not, but you should stop expecting SCHD to be something it was never designed to be. SCHD isn't trying to become the fastest growing ETF. It isn't trying to produce the highest yield. It's designed to invest in financially strong companies with a history of paying and growing dividends. And if that's the type of portfolio you're trying to build, SCHD still deserves serious consideration. Remember, successful investing isn't usually about finding the perfect ETF. It's about choosing investments that match your goals, staying disciplined, continuing to invest consistently, and giving your portfolio enough time to grow. Because in the end, long-term wealth is often built through patience, not constant changes. If you enjoyed this video, be sure to subscribe to Asset Index for more ETF comparisons, dividend investing strategies, and long-term wealth-building content. And now I want to hear from you. Are you still buying SCHD in 2026? Or have you moved on to another ETF? Let me know your thoughts in the comments below. As always, thank you for watching. And I'll see you in the next video.